Welcome to the first edition of the Market Action Pulse here at LLama Research. What we want to do basically here is, understand, where we are right now and how we got here, and basically where we can go. We'll try to bring in as much data as possible and try to make sense of it. So it begins with sometime in 2022 when I was sitting with my mentors, and effectively we were talking about something of a world which is called a VUCA world. The VUCA world is VUCA. V stands for volatility, U stands for uncertainty, C stands for complexity, and A stands for ambiguity. And then back in 2022, when we were talking about everything was quite okayish. There was nothing, and when we were discussing it seemed a little far away. And fast forward 3 years, we feel, at least I feel here that we have possibly started to enter a world that is very volatile, very ambiguous, very complex, and very uncertain. And that is where we become a little tense around how we manage our finances, because tomorrow seems very uncertain. So how did we basically get here? If we start with a long story, it would be a little difficult. But if we start from, let's say, December of last year, January of this year, then the story is basically back in December, January, everything was okay, pretty much fine. There was a trade that was going on, which was called the American exceptionalism trade, which was that people were trying to make America great again. And America being the capital of financial markets, it draws a lot of attention basically from what they do. Jerome Powell here, he's basically the Fed chairperson. What he did was that he brought in a lot of liquidity between October to January this year, or October last year, January this year. October last year, we saw a massive 50 basis point cut, followed by 25 basis point cut. That means a good 100 basis cut in almost like 3.5 months, which is where liquidity started flowing in. And that reflected in the markets. So if we look where we were in February, Dow Jones here was basically almost at a all-time high. The dollar was super strong at 110 index. So equities were up, dollars were up. It was basically shining in winter. And then one event started changing, like a snowball effect. One particular event started the what we call an uncertain world as such. This is what happened basically in February sometime, wherein a dispute which could have not, led to a lot of things started, as I said, maybe started a snowball or something. And it actually started over a thank you. It's funny to think about it that, two simple words bring in such a big change in what a markets could do. Basically, 2 years back, Russia had invaded Ukraine, and Russia sanctions were put on Russia. There was some bit of trust broken in terms of a trade which is called de-dollarization, wherein dollar loses value. Post this confrontation at the Oval Office, both equities and dollars started, basically US equities and US dollars started getting kicked, because effectively nobody knew which side who was leaning into. If this was not enough, we soon got tariffied. Basically, all the hard work that Jerome Powell he had done over the winter got nullified. Why? Because tariffs effectively are something of a one-time price shock as such. Mostly unfortunately, remember the first slide where he was pushing out money from an helicopter? We call it helicopter money. That was being blown out. Generally, a policy decision gets reflected into the markets about 6 months later. So understand, between October 2024 and 6 months later, during April, is when liquidity was starting to come into the system, and things could have gotten better. But a tariff on that point of time sends a one-time price shock up which eventually started a lot of started giving a lot of issues. So yeah, so this is how dollar and tariff and the index or the US index all have started reacting. So this is where the Zelensky meeting happened, and this chart basically is dollar index in 2016. This is the last time Donald Trump had become president. 2024 is the one time that he gotten re-elected. From the 1st of September going forward, almost a year, the dollar was showing uncannily resemblance this time around as well as to how it was doing in 2016. And it was doing quite fine till the Zelensky meeting. That is why I said it was a very important event that happened. And that's where the trust in dollar broke, and we saw dollar losing a lot of value. It was starting to recover back, and then we were hit by tariffs. So that broke another leg of trust, and you can see that dollars started to lose value quite rapidly over the last 2 months. So all this volatility, all this uncertainty that we feel right now as to not understanding where what is standing is just because of this one single matrix. And if we actually want to look back in what happens to, let's say, markets, because everyone's concerned about what their equities would do actually, would tariffs kind of bring a problem, or will basically the question, will equities go down, right? If history is the past successor of anything, there was a tariff event back in 1922 that was called the Fortney-McCumber tariff. This is when those tariffs were introduced. Post those tariffs, the market did fall. One quick leg of fall was there, post which the previous all-time high was taken out, and then you saw another leg of fall, post which there was a large boom in the markets. So despite all of that, back in 1922, market did well, honestly. So even if things look uncertain right now, if you look back at history, maybe if they were to repeat or rhyme, then it's not that much to be worried about. However, there is another problem. There's a problem about inflation. The last time that tariffs were introduced was in a cycle. So basically, this is US inflation trend since 1914, and it's a weird trend. Basically, if you see, inflation keeps moving up in the cycle, up and down cycle. There is a period of 15 years of down cycle, followed by 15 years of up cycle, followed by 15 years of down cycle. They change about plus minus 3 years. That's fine. We cannot be exactly on the clock every time. So then you see an 18-year up cycle, and then you see an 18-year down cycle. 2008 shortened the cycle last time around, and you got a 10-year of up cycle and a 10-year of down cycle in tariffs, in inflation, sorry. And now what seems seemingly is possibly that we are in an up cycle of some years, at least, according to what we think it could be 12 or more years. The last time that tariffs were introduced, it was introduced in a down cycle, and that basically is what supported the markets in such that one-time price shock did not affect those markets too much. If you will look at right now, if there is a one-time price shock that comes through, at least in the inflation, which is because of tariffs, this chart would start looking very weird, and that is not a good place to be. Yeah, and then what we do is that we want to solve the problem of inflation and tariffs. So we solve it as the most common sense thing that we can do, because nothing says that you're great again than you to poke a sleeping lion. So any disruption in supply chain only amplifies the problem. If you go ahead and choke oil reserves across the world, or choke supply chains that supply oil to the world, you're gonna get higher tariffs as such, higher inflation as such. So this possibly is the most the most different way of solving a problem, not the first one that I would have reserved to, or sure. So what are fundamentals in the US signaling to us? slow and steadily, they are turning for the worst. If you look at the US GDP, it's turned negative the last quarter. You're at minus 0.5% right now. The inflation has started to pick back up, and this is core inflation. This excludes. What does core inflation mean? Core inflation means that you remove out energy prices and you remove out food prices. Now, why do you remove out energy prices and why do you remove out food prices? Because they are kind of volatile, right? So if they are volatile, this core inflation is the one that is the one which is the stickier one. This is Fed's favorite go-to indicator as to if they were to how monetary policies would effectively take place. So this is one parameter that Jerome Powell looks at a lot in terms of what to do. So that started to pick back up again. Personal income has had quite a big drop, and obviously when incomes drop, GDP drop, you would expect the expenditure to drop as well, which is how expenditure is moving as such. However, one factor that is supporting the markets a lot, apart from the liquidity that was thrown back in October 2024, which is hitting the market right now, one factor that is supporting the market so much, and you see so much of euphoria out there, is because the labor market is quite strong at this point of time. This is something called Sahm Rule. This is our indicator, LLama Research's indicator to go and look at how labor market performs. What is Sahm Rule? Sahm Rule is basically a particular, is named after Claudia Sahm, a former government official and economist. What she said was that if you look at 3 months of unemployment, the average of 3 months, and then when you compare it to the lowest point of this number across the last 12 months, if you get a number more than 0.5, that would indicate that the economy is in a recession right there, right? The minute this indicator goes above 0.5, you can assume that the economy is in recession. Generally, the institute that kind of declares the recession, they declare the recession around 9 to 12 with a lag of around 9 to 12 months. If you use this indicator, it is an early indicator that one can use to understand where the economy is going through. Till July of 2024, this indicator had a perfect score of detecting an inflation every single time. Last year is the first time that it gave a false signal as such. So this is where we believe that labor is pulling through a lot. Even though this indicator went above 0.5, the economy did not enter into a recession. Currently, the indicator sits very comfortably around 0.27, and the GDP is negative. How do you define a recession here? The definition of recession is that you have to have 2 quarters of consecutive negative GDP to declare an economy in a recession. Last quarter, we had a GDP print of minus 0.5. If the next quarter comes out to be negative, we can start to assume. Again, there are different parameters that are used. This is a very simple parameter that I'm telling you that 2 consecutive negative quarter GDP is a recession. The institute that declares the recession, they use other parameters as well. Hence, we don't believe, and the early indications that we are getting on GDP data coming from US and the strong labor market, we don't feel that US is headed into a recession straight away. We could pull back from here on, thanks to the liquidity that was supported to the market and the people of America who are pulling this through. So what's in the mood of the markets in US? Definitely greedy. Why? Because fear would be too mainstream. Given the poor economic data that we've seen, the markets have turned really greedy. This is the fastest ever rebound that we've seen in the last 50 years in S&P. The index hit a low, a drawdown of 21% post the tariff announcement. Just post the Zelensky meeting and the tariff, S&P was down 20%. The number of days that it has taken to come back and reach new highs is 57. So this is the fastest ever rebound that has happened into the economy. Again, I can't reiterate this enough. It's the liquidity and the labor that is pushing this through, because the economic data of US does not look to be very encouraging. Now we've covered US because US is still the financial capital of the world, and they matter a lot as to what the rest of the world does. While we are okay, yeah, just one last time again that we are pushed into a yeah, okay, sure. So we are pushed into this economy with liquidity on a with liquidity going forward. This is an interesting chart. Very recently, Chess Research came out with this chart. What they have done is that they've compared M2 with S&P 500. M2 is basically the money supply in the market, that how much money is flowing into the market. And what they have done is that they have lagged S&P returns by 11 weeks. And it has a very uncanny resemblance to how the money supply is there in the market. So the money supply right now is pretty high. The liquidity is very high, and hence I feel that markets are supported as such. That does not mean that you go out and buy just because I'm saying so. It can come down. It's not there, but it's not in trouble is what the liquidity tells us. The data of economics tells us that there is problem. But given the early indications that we are seeing, at least in terms of GDP and other indicators, it does not look like that the recession is coming like just the next quarter, because the next quarter is when that second negative print can come in. Moving over to India, how is India placed? India is placed much better, and that's kind of fairly to say that it's the fastest growing large economy. It is kind of witnessing a change of sorts. It has a younger population with a push by the government, and India is on a very different path. What are the events that have taken place this year, at least in India? We've got a very consumer-friendly budget. We've got an internal geopolitical pressure and tension rather, and we've got the Iran-Israel-US problem issues in the Gulf. The issues in the Gulf basically affect India a bit because we are importers of oil. So any again supply chain disruption over there affects us a lot. However, we've also been given a liquidity boost by a massive rate cut by RBI. So events in India, apart from the war, have been quite friendly for the consumer and the markets, and that is why foreign institutional investors are coming back into India. They were net sellers in Indian markets all over last year, particularly the second half of the year. They were selling quite aggressively. What we've seen is that they have been able to come back into the markets. We've seen very large inflows in May and June this year. Big numbers as such, around 11 and 8, which is around 20k crore by FIIs, and DIIs continue to be net buyers of the Indian economy. They've been the one who's been supporting the FII outflows for quite a bit now, like almost multiple years now. So they continue to be net buyers as such. And eventually, if you look at this is a very, very interesting slide as such. This is India being the place to be. What I've done is that we've compared S&P in USD terms, and actually I've compared it in Bitcoin as well. Why? Because we earlier saw that trust in USD or US dollar was kind of breaking down. So it made sense to move to a kind of a neutral place as such. And Bitcoin seemed to be a very most reliable option to go into. So when you compare in terms of Bitcoin, S&P is not at an all-time high. It's lower than an all. If you take the last 5 months of returns, it's still tagged there. It's not moved, like it's not there at the high. Obviously, the markets are quite buoyant right now, and there's quite a lot of greed out there. Bitcoin in terms of USD has moved around to 2.5% over the last 5 months. The dollar index has been the massive thing that has lost a lot of trust. That it's down like 10 odd percent. And the beneficiary of losing trust in US dollar has transferred to not Bitcoin but gold. Gold has been the beneficiary of this loss of trust. We've seen gold return around 18% in USD. When you compare it with Bitcoin, gold is kind of 15% up on Bitcoin. And when you compare S&P returns to Nifty 50 returns, we have a 8.2% return here on Nifty 50 over the last 5 months when you compare it with Bitcoin numbers, and around 10-11% when you compare it in USD, and 9.5% around when you compare it in INR terms. Just looking at the signals right now, while the economy is quite buoyant, the numbers are coming in quite good, institutions are buying, there are very early signs of kind of fatigue at a very high altitude. We've been growing very fast, and while CPI data or the consumer price index, the inflation data is quite supportive. It's kind of coming down. GDP is kind of being sticky at around 7.5% odd, doing pretty well. The early leading indicators of PMI and some bit of IIPs have started to show fatigue as such, and that could lead to moderated returns going forward. Risk to reward ratio is not favorable as such for us right now, and hence what we understand is that when we go back to the previous chart or the previous table, we feel that the valuations are a tad bit high for Indian markets, given the massive run up that has happened very recently, being 8.2% in Bitcoin terms, when the capital market is as such down 0.3%. There is some bit of kind of fatigue at a high altitude, and yeah. So what are the concerns in the immediate market as such? There are not many concerns. There is one, obviously, that is the energy price risk concern. The second concern is basically the geopolitical and the instability and the tariffs. And the third, the one that I spoke to right now, was the valuation risk. These are the three major concerns at this point of time that the Indian markets are exposed to. And given that our global equity view, this is LLama Research's global equity view for a world that is volatile, uncertain, complex, and ambiguous at this point of time. We are the most weighted in India right now with a neutral weighting, while we are quite underweight on US and Japan, and some bit of underweight in China. And this is the kind of this is our equity allocation as such that we are going with at a point when things are not absolutely, the jigsaw is kind of not solved. We're trying to solve the jigsaw every day with incoming data, with tweets of Trump in the morning. It's a very funny story that we've kind of changed the way we start looking at or start analyzing. Earlier, when we used to wake up, it would be a business newspaper that you would read into. Now you end up reading tweets of Trump to understand where we are headed for the day or for the month or anything. So with this, I think this is the GPS that we are going with. In our form, we gave in some bit of questions, and then I'll just open the floor for other questions. The questions that we received were basically, how vulnerable is India to global geopolitics? Well, as I said, that the world is volatile and ambiguous. We are moving into something from a globalized world into a fragmented world. So think of it as something which is very similar to a Cold War, wherein blocks which were previously allies are not allies anymore, and then different kind of allies form. So globalization is basically fragmenting into very strategic blocks, and for this, businesses have to adapt as fast as they can, and there will be sector-based specific impacts as well on certain things. So where we were basically was kind of a globalization light kind of a environment that we said just when we were in COVID. If your sector is non-strategic, okay, then you are more likely to move towards friends kind of stage. If basically the sector itself is emerging strategic, then also you may want to stay into onto a French place. But if it's highly strategic or a traditionally strategic thing, then you are more likely to move towards the nationalist statism place. So you would want to protect your own economy much more now than what you would want to do earlier. And that is how the global geopolitics is reshaping itself in a world that is shaped by alliance and nationalism and very selective cooperation. So it does mean obviously that India is quite vulnerable in that stage. There are alliances forming every day. There are news coming out every day. Or for us, it is more important that how financial markets work. We are not geopoliticians, so as such, I don't have much to say more in this. But this is the framework that we are kind of going with. The next question that we've got are that which are the pockets that are looking good for investing at this point of time. So our in-house sector positioning is kind of something which is called which is more tilted towards cyclical than sensitive, and a fair bit of defensive. So how we are placing this as that we quite underweight on IT, autos, and in banks we kind of like public banks more than private banks. And apart from that, cyclicals look quite okay. This is basically a situation where an economy is basically in mid expansion. So India, what we believe, is moving away from a mid recovery period to a mid expansionary period. There is some bit of momentum up there, we're moving away from recovery into mid expansion space. There is, however, wherever we pick select sectors and companies within those sectors, we would want to have stability and quality with much room to grow. Another question that we got was that in India, if you were to create alpha right now, would a buy and hold strategy work or a sector rotation strategy work? So what we believe is that in a VUCA world, in a world which is volatile and ambiguous, complex and uncertain, complex and ambiguous world, you have to be patient with the micro and very agile with the macro. So while buy and hold is not dead, blind and being hopeful is kind of not the right place to be. So India is quite a big compounding story, possibly in one of the best best decades of our time. So however, when your economy keeps on shifting between mid recovery and mid expansionary, your sectors keep on rotating very fast. So the leadership kind of in the sector rotates very fast. So the idea is basically to own the compounders and basically then rent the themes. So your core portfolio has to be built with compounders, while your satellite portfolios can keep switching around. It's quite fast as such. All the themes cannot be caught. It's okay to. There has to be some bit of joy in missing out on some of the themes. It's fine. You can't be at every table in a party, which is fine. But then some bit of themes you can rent. But your main portfolio has to be owned by compounders. As I said, in a VUCA world, the business cycle keeps flip-flopping very fast, and if you're just a theme-based kind of an investor, then it becomes a little difficult because the themes keep on changing every other day. Another question that we was asked to us was that please provide me with a multi-bagger. While I cannot do that, I can give you a framework to kind of look at it. There's a particular book by Christopher Mayer called 100 Baggers. And to find a multi-bagger, the main important portion is basically that patience is the key. So a few learnings that are from this book, and this is a book I recommend for if you're looking for multi-baggers and have the patience to hold them. Then if you buy right and hold for long, certainly multi-baggers can come through. The other thing that the book talks about is that the promoter skin in the game is kind of a non-negotiable. You look for high ROE plus reinvestment, basically very stable business, and something which is of very high quality. You avoid the noise around the business. But obviously, a business, if it has to become multi-bagger, it has to survive more than a few years. So there will be certain bit of noise across it. One has to have conviction around that to avoid that kind of a noise. However, one thing is that valuations do matter when you are entering into a business. If a very high quality very high quality business bought at a very wrong price can lead to a lot of pain for a long period of time. So valuation do matter when you enter it. And generally, multi-baggers come from sectors that are either underinvested for long or the mega trends of tomorrow. So what we believe is that the sectors that are underinvested right now are basically sectors which are very cyclical in nature: metal, coal, power, textiles. Think of any boring business around you that has not been invested into over the last so many years, because all the money that has been invested into has gone into technology as such. All the boring businesses have not been invested into. When your technology gets driven by these boring businesses start looking very interesting. So that is a certain thing. And the mega trends of tomorrow that we believe are basically artificial intelligence, biotech, robotics, big data, and the ethical use of data. So these are the things that we are working on, at least around megatrend. We believe that these are megatrends for tomorrow, and believe that certain bit of multi-baggers can be found in such spaces. Um, yeah. Again, one of the another question was basically how has been our performance as such. While we run different client portfolios, because every client is very unique to us, we try to understand where you are in the journey and what you want deserve out of a portfolio. But this is one of the portfolios that we run, which is called Galloping Games, and the returns versus Nifty and Gold and portfolio has been quite. The portfolio has been delivered quite recently from the day we started running it. This is kind of a live portfolio, and we keep on running it. So again, something that again to this question, we don't know. It depends on market cycle to market cycle. The markets have been very kind over the last 2 years, in which the portfolio was tested around. So again, market cycles change, performances changes. We cannot guarantee that this same market cycle will repeat, but this is how performance has been there for us over time. I think I'll just open the I'll kind of go back into the tab and open the floor for any questions that you've got, which I can answer.
So in one of the slides, we talked about how the Indian markets are a bit overvalued, but we are still bullish on India. So how does one look into it?
Karan bhai, you're muted.
Yeah, thank you, Ashil bhai. Parag, basically among equity, we are the most overweight in. So the best in equity that we like is the Indian markets. We are neutral on India at this point of time. There's no overweight as such. We believe that the markets have delivered decent performance over the last few months, and the valuations look a little bit higher. We're not overweighting our positions, but kind of maintaining a very neutral stance to it. And along with that, some bit of sector rotation also helps in that.
Karan, just wanted to understand, like you specifically mentioned that the boring sectors in India looks interesting from an investment point of view. I couldn't understand that context why these sectors look, because in the age of AI, you are promoting those segments. So why that thought process is there?
Rahul, thank you for the question. No, so AI is basically the mega trend for tomorrow. I believe a lot of things will be done on AI tomorrow. The other things that are really good are basically green energy and the new age things. Well, all of these green energy, the solar energy, AI, data centers, all of them run on wires which are made kind of out of copper. Or you're building a country which is more than a billion people and growing fast on infrastructure needs steel bridges. While between the last decade, we've not seen a lot of investment into these particular themes. The investment has been more of digital in a nature, wherein people have gone for speed rather than quality kind of innovations. We believe the next couple of decades will be of innovation which are quality nature, which run for a longer period of time rather than speed and digitization. So sectors like whether like sectors like which enable digitization of quality and are boring at this point of time make a lot of sense. So that is why we are quite bullish on commodities as metals as such.
Sure.
Okay, thanks, Rahul.
Karan bhai, in the last slide, you showed one of the portfolio's performance, right? So on the left, the numbers are like, are they in like bips or what?
So just give me a second. I'll go back to that.
Yeah.
So so this number is basically we started on it's the value of 100 rupees. So we started at 100 rupees on 31st March of 2023, 31st March. We started with 100 rupees, and this is basically the value of 100 rupees that has gone and till 30th.
Okay.
Yeah. Cool. Are there any other questions that that I could answer to? And quite right on time there. It is a kind of a very difficult period as fund managers and portfolio managers and investment advisors. I feel that over the last 15 years we've misused the term like it's a very difficult market quite a bit. Right now, what we feel is that the markets have changed meaningfully over the last few months, and then it is quite a difficult space to be as such. Certain tweets change a lot of things. Certain strikes make a lot of changes. And to survive in this particular market, one has to be very nimble. One has to be very agile. And what we feel is that it's okay to miss out on a few on the upside rather than be caught, on the downside. So maybe there should be some bit of joy in missing out, because it's quite a difficult and quite a volatile market out there. What happened post tariffs? Nobody, and myself included, none of us thought that the market would reach all-time high within the next 2 months. This has been like the fastest recovery ever, all driven by liquidity. This is something that nobody had thought of. So it's quite a different market out there, and things are changing quite a bit. It's okay to hold on to some bit of cash at this point of time for opportunities which seem which could possibly present themselves in a couple of months. So I think that's how I would want to sum this up eventually. Thank you again so much for your time.
Hi, Karan. This is Vikash here.
Yeah, hi Vikash.
Hi, Karan. I just wanted to ask you about what is your opinion about Bitcoin? In this world, I mean, in the recent times when people are losing a little faith in USD and gold is soaring up. So the same scarcity applies to Bitcoin. However, they are again, the people thinking about the Ponzi scheme and blah, blah. So what is your idea about this upcoming asset class? If at all I can call it an asset class.
A very, very interesting question. Bitcoin as such is an asset class on its own. We believe it cannot be pushed under equity. It cannot be pushed under debt, or it cannot be called a commodity. It's a technology, what we believe, which it's a mix of all of it. It's a mix of currency, it's a mix of technology. Bitcoin can, what I have understood in Bitcoin, and been following Bitcoin since a few years now, back in 2017. And similarly, I wanted to understand what asset class would Bitcoin belong to. So I started off thinking that it's a technology one, which is kind of maybe a bit of risky asset, and possibly that was there. Over time, the change happened that possibly Bitcoin is something that would save you if there was fire outside. If the world was going down, Bitcoin is something that is of a protective nature. That trust got broken in Bitcoin in the COVID crisis. Bitcoin fell along with other risky assets. So possibly that's not the reason why Bitcoin exists, or possibly it was not there at that point of time. If that use case of Bitcoin exists, over time it has also acted like commodity, it has acted like currency, it has acted like technology. So it's a very interesting question as to where Bitcoin lies. What we believe is that it is trying to find a place in people's wallet over time, and that's where Bitcoin can land up eventually. But it will have to make its place out there. Given that something that is in your wallet cannot be so volatile, it has to come down and make its place. The eventual thing of Bitcoin, what we believe is that possibly the debt of US is quite high. So they'll have to restructure their debt at some point of time. So that restructuring can happen. There is the possibility that it can happen through a cryptocurrency. That would reduce a lot of debt of US when measured in that parameter, and that could be a possible use of a cryptocurrency. So yeah.
Okay. Yeah.
Thank you. Thank you.
Thank you, Karan.
Okay. Okay. I think if there are any other questions, I'm happy to reach out to connect post the call. It's already, I think, it's time. Thank you again for evening, and your time, and have a good evening ahead. Thank you so much.
Thank you, Karan bhai.
Thank you,
It was
Ashok.
a very good session.